One of the problems with recruiting for investment banking is not the knowledge or skills you acquire, but the access to talk with real investment bankers to put your best foot forward. Our sponsor, WSO Academy, can provide those connections with 60 head mentors who are finance professionals at top firms like Goldman, Centerview, and JP Morgan. Imagine being able to get on the phone within 24 hours with one of the Academy's 1,300 mentors right before a critical interview. Get on the waitlist for WSO Academy today by clicking the link in the show notes or by visiting wallstreetoasis.com/academy. All right. Welcome to Investment Banking Insights, the only podcast dedicated to helping you learn both the technical and non-technical aspects of investment banking. My name is Alex Mason, your host, and you know what it is. What are we doing here? We're studying investment banking fundamentals, and we're now looking at M&A, mergers and acquisitions, the combining of two different companies. What are the idiosyncrasies involved in this process, and what are the basics? That's what we're talking about now. And today's question is focused on how a company pays for another company. Why would a company not pay 100% cash for a company if it could? So imagine a company is buying another company in an acquisition, and it has the cash on the balance sheet. It doesn't need to issue debt. It doesn't need to issue stock, but maybe it goes 50% cash, 50% stock, or 50% cash and 50% debt that it raises. Why would it do that if it already has the money? Well, let's think about these things because it really depends on the mindset and the perspective of the CEO and the CFO, the people who are making these major decisions for the company. If we kind of sit in their seat for a moment and think about how they're running the company and how they're thinking about acquisitions, it might make more sense why they would not pay 100% cash in some scenarios. So first of all, maybe the company wants to use this cash for just something else. I mean, there are a number of ways that a corporation can use cash, and these are the main ways. The first way is by making an acquisition. Another way is they could pay dividends to shareholders, actually sending cash to shareholders. They can also return cash to shareholders in the form of stock buybacks. They can retire existing debt, pay off some of their debt. And then the last way that a company can allocate its capital is by somehow investing in their business. So maybe the company is trying to do a balancing act. There's a lot of different things going on, especially in major corporations. So maybe they want to keep some of their cash in reserve for a dividend, for a buyback, for debt, for a growth initiative, and then use some of that cash for an acquisition, or maybe even none of it. So that's one thing that you might be thinking of as far as why a company might not use 100% cash for a company, even though it has the liquidity and the cash resources on the balance sheet. The second thing we could think of is the company might want to keep some cash in reserve for a rainy day. I mean, just like you and I have money in our savings accounts just as for emergencies, companies do that too. And a company's version of an emergency could be something like a recession, when things aren't going so well, when revenue isn't growing so fast, maybe even declining, maybe profits are declining, especially in cyclical businesses. You might want to have some liquidity there. And liquidity can come in the form of a credit line, but it can also come in the form of cash on the balance sheet. So maybe the company management is just saying, you know what, I just want to save this for a rainy day. And then another thing that a company leadership might think of is if the stock of the buyer is trading at a premium, they might want to use their stock as a form of currency in order to preserve their cash levels. So imagine you're running a business and let's say that it's publicly traded and the stock gets bid super high, like the valuation just goes way up. Everyone wants your company stock. It's trading at an incredible multiple. And then you see another business that you want to buy. Well, you could pay cash for that business, or you could use this really nicely appreciated stock that you have and say, hey, I'm going to issue new shares at these high prices in order to buy you out. And you know what? The target company might be okay with that because they just want they want the money, right? And they may be okay with it in the sense that the stock has performed very well. So they may be okay with getting all or part of their compensation in the form of company stock. And it's advantageous for the business doing the acquiring because they don't have to give up their cash. They can literally just create equity, and the value kind of gets created out of thin air. It's kind of amazing because there's a high demand for that stock. So even with dilution, even with creation of new shares, people will want to buy the stock in the market, so it has value. So that could be another reason why a company wouldn't pay 100% cash for a company, even if it has the resources to do so. Okay, that's what I got for you today here on Investment Banking Insights. My name is Alex Mason, and I'm your host, and I am so grateful that you're listening. Thank you for checking this podcast out and going through this with me. Next time, we'll be talking about strategics versus PE firms, what the differences are, and how that plays into the M&A process. I'll see you there.